Capital. Hassan, what is capital? Investment. Equity or long-term loan, whatever you take. Investment is basically the capital. And budgeting is the planning. Okay. And planning in quantitative terms, we call the budgeting. So it means this is a topic in which you are going to plan whether you should invest into a business or not. Okay. So that's what you're going to plan. So that's why the other name for this topic is, we also call it, what's the other name? Very good. That is investment. Let me write it in bracket. Investment appraisal. So this is the other name. Means you have to evaluate, you have to appraise whatever you have invested or you are going to invest. So this is the topic which we are going to study. But before we evaluate our investments, because this investment, when we say the evaluation of investment, this relates to future. Okay, so future involves the devaluation of money, because the economic system for the whole world is such that the money gets devalues. Yeah, money loses the value with every passing time, every passing day, every passing month or year. Why? Because in every country it happens like this. If you think about the long term, you start thinking 50 years ago of any country and see today, money has lost value. This is inevitable situation. We are not talking about maybe in 1 year some countries may gain their currency may gain the value, and in the next year they may lose the value. But overall, it's a downward sign. Why is that so? Because of the nature of the economic system we have. Previously, it used to be a barter transaction situation, right? What is barter transaction? You give 1 kg rice and take 1 kg wheat, suppose. Okay. So there was no inflation in that because 1 kg rice is always 1 kg rice. Money was not there. Yeah. One was the barter transaction and other was the gold, basically gold and the silver. So you could have exchanged these two minerals, these two things, metals in exchange of the foods or something. Okay. So again, even if using gold or silver, still there was no concept of inflation. Why? Because if let's suppose you have 1 coin of a gold, which is let's say 10 gram or 1 gram weight of 1 coin, and you say that the price of the wheat is 10 gram gold, so 10 coins. So what you will do, you will give 10 coins of the gold and get the 1 kg of the wheat. So every time 10 coins of the gold means 10 coins of the gold. They can never be 11 coins or 12 coins or 13 coins until there is a shortage of the uh, wheat, or there is excess gold invented or excess gold coins. So it means whoever had more gold coins, those people were considered as the rich people, same as today. Now, then what happened? With the passage of time, let's say I was the person, you guys are the businessman. Okay. Hassan had 100 camels carrying gold and silver, and Munib had 500 camels carrying the food and everything stuff. Now, what Hassan had to do, Hassan had to hand over the 100 camels of the gold and silver to Munib, and Munib will hand over the 500 camels of the food and whatever the stuff that is. So I suggested them, I told them that why you guys are, and vice versa as well. Hassan might have some other crop, and Munib will also have some gold and silver along with the crops. So they had to carry everything on gold coins, because they will give gold coins and get one crop, and maybe they will give some crop and get golden coins in exchange. So they have to carry gold. Everyone has to carry crops and gold, etc., gold along with them. So I suggested them that every year you are coming here with all the gold and etc. And 100 camels are with the gold. Why don't you put your gold with me? Everyone, I will give you a receipt. So put your gold with me, and I am a trusted person, let's suppose. So you don't have to carry the gold along. Next year, what you do, simply come with the crops. Let's suppose Hassan says, okay, I am selling 100 kg of wheat to Muneeb, and Muneeb has to give 10 coins, suppose. So what I will do, I will give a receipt to the Hassan signed by the Muneeb, which will tell you that, okay, I am shifting 10 coins from Hassan's account, sorry, from Muneeb's account to Hassan's account. I will give you the receipt that I have shifted this 10's account. Don't worry. Okay. So Hassan will have that receipt. Now Hassan has one receipt. Let's suppose he deposited 100 coins already with me, and now he got 10 more coins from Muneeb. So in his account, there are 110 coins, and Muneeb's account, there are 90 coins. Okay, every year it happens. Time came when Muneeb had only 20 coins in his account, but Muneeb wanted to crop for, let's say, 30 coins, but he doesn't have the 30 coins. He came to me. He said, "Sir, I want the crop." So what you do, just give the receipt of 30 coins to him. All you need to do is to give a receipt to Hassan that I have shifted 30 coins from his account to your account. Actually, there were only 20 coins. But what I did, I issued a receipt of 30 coins to Hassan. Okay. Now Hassan has a receipt of 210 coins in total. Let's suppose if there was, we are assuming that initially 100 coins belong to Hassan, 100 coins belong to Muneeb. Muneeb started purchasing continuously, and now Muneeb has purchased 10 coins more than what he had. So Hassan has receipt of 210 coins, whereas I have only 200 coins with me in the bank. Let's suppose I have done this with so many customers. I will be in trouble when the people will come and want their gold back. No, it's a bank. Okay, what they did, they just simply got a receipt from Muneeb. So instead of Muneeb giving gold to them, Muneeb will sign something and say, okay, give this to Mr. Malik and he will transfer gold to your account. Just like a check. With a check, you sign something, you give to the person, go to the bank, bank will transfer money from my account to yours. So it's a check. People can give each other check, and whenever Hassan will come to me, I will transfer the coin from Muneeb's account to Hassan's account. But the issue is, let's suppose I have done the same thing with 100 people. No problem. Hassan one day comes and says, "Sir, I need my 210 coins." Although I have 10 coins short from the Muneeb, but I won't have any problem because I will give 10 coins of someone else to Hassan, because I have coins of so many people with me. Let's suppose all the people come to me and say, okay, give our gold back. That is the time when I will fall bankruptcy. I will say, okay, bank has gone bankrupt. Now, in that case, this started to happen in multiple banks. Actually, this was the way when the banks were established. Okay, this is the way how the banks were established. People said, okay, give gold to us. You are carrying very heavy gold, so you will save your energy and you will save your place and you can bring more crop instead of bringing gold coins and etc. But along with that, human nature, this started happen that they started to issue fake receipts. Okay, there was not, those receipts were not backed by the gold, actual gold. Okay. Now, what it did it create? This created more receipts in the market than the gold I have in my account with me. Okay, that's called inflation. When you have more currency notes, now what that is, that you can call it, it's a currency note. Previously, it was simply signed receipts. Now we call them the currency notes. If you see on any currency note, there is something written related to gold. I don't have any my wallet with me. Anyone has some? I don't know whether it's written on the dirham or not. But in PKR, Pakistani note, there is written one thing, one statement. Anyone have any note? Okay, she's sitting online. Sorry, Amelia. I'll just put the mic off. Okay, anyway. So this statement on the currency note shows that you will be given something equivalent to value of this currency note. Now, what that something is? Gold. Yes. Every currency is backed by the gold. It says that you have a gold with the authorities which belong to you equivalent to the value of this currency. Okay. But the issue is many countries do not have enough gold behind that. So what they do, they simply just print the currency notes, but they don't have enough gold backed by that. Now, if you don't have the gold, then there is another universal law that you must have dollars. Every currency can exchange to dollars and dollar can exchange to golds. This is a universal law. America being the economical superpower. Yes, let's suppose if any country doesn't have any gold, they want some loan, they will get the loan in dollars. Okay, then well, let's suppose I am the country, I don't have the gold. I will get $10,000 loan from the Central Reserve Bank of the USA. I will get IMF, which you call. I'll get the loan from the IMF or any international loan organization. What I will do, I can't use dollars in my country. Dollars are not used. But what I will do, I will print the currency notes equivalent to $10,000. I will print out my country's currency notes equivalent to the worth of the $10,000 because as a country, okay, I'm a country, okay, let's suppose, and I have to, I don't have the gold, but I need some money to run the business of my country. What I'll do, I'll ask IMF to give me some loan. So IMF will give me loan in dollars. Okay. So whatever the dollars I will have, I will print out the currency notes equivalent to the value of those dollars. Let's suppose I got the $10,000 loan and I printed the currency notes of $15,000. So what did I do? I simply have printed more papers. Currency note is what? It's simply a piece of paper. The issue is it's going to increase the cost of the goods in my country. Why? Because now the people will have more money, but the things are same. Let me understand you with a very simple example. Let's suppose if I have this one mobile phone and there is only one mobile phone in this classroom, which I have that, and I'm going to sell it. And all of you need this mobile. Every one of you need this mobile and you cannot buy any mobile from anyone else. Why? Because there is a shortage of mobile and this is the only one mobile. What should be the price of this mobile? So who can purchase this mobile? The one who has the highest amount of the money. What happened? The price of the mobile increased. Why? Because the goods are less and the money is more. Whoever has the more money, he will purchase that. So printing the currency notes mean providing with the people the more money. So the prices, the goods are the same. You are not increasing your industry. You're not growing your industry. Okay. You have the same goods, same level of products, but you have given more currency notes to the people. As a result, the prices of the goods will increase. That's called inflation. Right? So inflation is an inevitable situation. Why? Just because of this currency notes. If there would have been the barter transaction, or still we would have been using the gold or silver as a currency, then the only country which have more gold reserves, that would be the more rich country. Okay. But now, as every country has its currency, which is backed by the dollars, and dollar is backed by the gold. So it means whoever either get a gold from your country, means if let's suppose if some country has discovered a lot of gold, what they will do? They will now get the dollars against that gold. And that will not be a loan. That is something which they have their own. And then they can print out the currency notes equivalent to that dollars. And then they can even buy the products from outside. They can set up their own industry with that money, that amount. They can purchase the machinery and everything. They can import the goods and they can do everything. Why? Because they have a lot of money now. Why they have the money? They have the gold. So whenever you are going to invest in a company, it involves future involves inflation. Inflation means your money is going to lose value. Why? Because let's suppose if something you can buy for $100 today, after 5 years, you may be able to buy the same thing for maybe $170. So it means after 5 years, $170 equates the today's $100. Amount of money will increase, but the worth will decrease. After 5 years, you can buy the same thing for $170, which you can buy right now for $100. So it means the worth of the money has gone down because the amount has changed, for the price of the same thing has increased. So the question is, if someone says, okay, invest in my company today 100,000 and I'll give you 150,000 after 5 years time. So the question is whether this investment is worth it or not. Now, on the face of it, it seems good. You are giving 100,000, you're getting back 150,000. But maybe today you can buy a house for 100,000. And after 5 years, the house worth 400,000. It means after 5 years, you cannot buy even a house, even half a house you cannot buy with that 150,000. Your money is gone. So that is called time value of money. Okay. Time value of money. So whenever we are going to invest in a company, we have to calculate the time value of money. Now, how much that money depreciates or deteriorates, it depends what is the inflation rate in that particular country. In the question, you will be given that rate. Normally, interest rates in a country are matched to the inflation rates. So if you are given with an interest rate, use that to calculate the time value of money. If you are given the inflation rate, use that as well. Or if you are given the cost of capital or required rate of return, these are the four things what I'm talking about, or the same thing. The first thing being inflation rate. Second, interest rate. Third, cost of capital. Fourth, required rate of return. All are the same thing. How all are the same thing? Because inflation rate is the rate at which the prices of the goods are going to increase in future. That's what we call, let's say it's 10%. Every year you expect that 10% prices will increase. What you will do, banks will keep interest rate of 10%. Why? Because banks know that if they are going to give a loan to someone after 1 year, they need 10% interest on that. Why? Because the prices will increase by 10%. So to accommodate that increase, bank need 110 back after a year. Same thing to you. Let's suppose if some price of some product today is 100, after a year it will be 110. If you were investing somewhere, you will ask him, okay, at least give me 110 next year, if not any profit, so that the value of my money is the same, continues to be the same. So you will get 110 back. Okay. So interest rate or the inflation rate is the same thing. Right now, we are not talking about profit. Okay. Right now, we are simply talking about the interest rate, which actually is equivalent to inflation rate. What normally, but they do, they keep an interest rate which is higher than the inflation rate. So the additional amount they get profit. Okay. Let's suppose you say, okay, give us 15% interest. So it means after a year, you are going to give the bank back 115. But the value of the money is actually 110. So that additional 5 is the profit to the bank. So normally what they do, they keep the interest rate a little bit higher than the interest rate when they give a loan to someone. Again, it depends what type of the loan they are giving. Maybe there could be some loans which are having a less interest rate. Some loans are having more interest rate. It depends on whether the loan is secured or not, or the type of the loan. Now, what is cost of capital? Means if let's suppose you need investment in your business, you want bank to invest that. So bank will say, okay, I'm giving you 100, but you have to give me 110. So that 10% is what? It's cost of capital. Cost of the capital which you have invested in your business. Let's suppose if you put some money into bank will give you 10%. I ask you to invest in my business. How much you will ask? How much you will require? What is the percentage of return you would like to have? 1 year, let's suppose. Bank is giving 10% interest on all the deposits. I ask you, okay, don't put money into the bank, give it to me. How much return you would ask from me? Minimum 10, actually, more than 10. Anywhere more than 10. Why? Because business carries risk. In business, your money could be gone. So you will say, sir, if I say, okay, I'll give you 10%, you say, sir, 10% bank is also giving to me and there is no risk. Why I should not keep the money into bank if I have to get only 10%? With you, I have higher risk. Give me 15%, then I will invest. High risk, high return. Where there is a high risk, automatically the investor wants high return. Only then the investor is willing to take that high risk. Because if there is no high return, why someone will take risk? It's better to put the money into bank. So cost of capital is what the required rate of return of the investor. Whatever the return the investor wants, for me, it's cost. Let's suppose you are investing in my business. So you are investor, for you, this is the required rate of return. For me, this is cost which I have to pay you. That's called cost of capital. But again, it's the same thing. So in the question, whatever the word is written with the percentage, use this percentage to calculate time value of money. How to calculate time value of money, that we will study. But right now, these are the figures. Before we understand how to calculate time value of the money, we have to understand the types of interests. Types of interests. The first one is the simple interest. What is simple interest? That let's say these are the years. Year 0, 1, 2, 3, 4, and 5. When I say year 0, I mean to say right now. When I say year 1, it means after 12 months, after year 1. Okay. Year 0, right now. Year 1 after 12 months. Year 2 after 24 months, and so. Okay. So these are the years. Let's suppose I am going to put some money into bank today at, let's say I'm putting, okay, let me take the straightforward figures, that is 100. So that you can easily understand the percentage phenomena as well. Bank says that I will give you 10% interest. So we are using the 10% for the calculation purpose. Okay. We can use 12, 15, doesn't matter. Now, it means after 1 year, your amount would be how much you would have in your bank. You have 100 and plus bank will give you 10% on top of that. How much you will have? 110. Bank will give you 10% of 100 every year. It's called simple interest. If bank gives you 10% of the principal amount, the amount which you deposited on the first day. So 10 pound, it means every year you are going to get 10 pound. So after 5 years, you'll have 150 in your account. This is called simple interest. This is never used by the banks. But just to tell you that how the simple interest is calculated. But in reality, banks do not do this way. What they do, they use this technique that is called compound interest. What is compound interest? That bank will give you interest on the total amount they have with them at any point of time. Let's suppose same years and you have invested 100 into bank. So after 1 year, it would be 110 because 10% of 100 is 110. But after 2 years, it will be 10% of 110, not 10% of 100, because now for this year, from year 1 to year 2, you have 110 with the bank. Got it? So how much it would be? It would be 110 multiplied by 1.1. When I multiplied 1.1, it means I am adding 10% into that. Okay, I could have done here at as well. 100 times 1.1, 110. Okay, so in 3 years, now bank will give me 10% on 121 because when the year started, I had 121 with the bank. So bank will give me 10% on this amount. So 121 into 1.1. 1 means 100.1 means 10. Remember in percentage terms, 0.1 is 10%, 0.2 is 20%, 0.3 is 30%, 0.5 is 50, 0.05 is 5%. 0.5 50%, 0.05 means 5%. Got it? So 1.1 means 110%. So I'm going to calculate 110% of 121, which is 133.31. Then 110% of this. And in the 5th year, so it means that if I have deposited 100 today, after 5 years, it will become 161.051. This is called compounding. Okay. What is the meaning of compounding? PV to FV. PV stands for present value, FV stands for future value. So present value to future value means this is today. You know the amount today. You are going to calculate that how much it will worth after 5 years. So that's called present value to future value. That's called compounding. But let's suppose if someone says, okay, invest in my company, I'll give you 150,000 after 5 years. So the person is giving you the amount after 5 years. That's the future value. So you have to convert that future value to present value. That is called discounting, opposite to the compounding. Let's suppose if someone says, okay, I will give you 161.051 after 5 years. If I have to calculate how much I will get today, obviously it should be 100 because I know that I have calculated this from 100. But if I don't know, how do I calculate? If the person says that the interest rate is 10% and I will give you 161.051 after 5 years, you just give me 110 today. Let's suppose you say, sir, give me 110 today. I will give you 161.051 after 5 years. And interest rate or inflation rate is 10%. When I calculated this at 10%, I found that today's value is 100. I will tell you how to calculate these values, but just trying to make you understand the compounding and discounting. I will calculate at 10% and I found that today value is 100. I say, no, it's not good thing. You are getting 110 from me today and you are giving me 161 after 5 years. 161 after 5 years in today's terms, it is equal to 100. So take 100 and give me 161. Okay, because at 10%, this is the. Now, how I have calculated this? If I have to calculate directly this figure, so what could be the formula? I will come to the discounting later, but first let's understand the formula and the calculation method of compounding. I have calculated it this amount into 1.1. Okay, then this amount into 1.1, then 121 into 1.1, then 133.1 into 1.1, and so and so. Let's suppose if I have to calculate for the 25th year, so would I do for every year? No, there is a formula for that. So that formula for compounding is 1 plus R first P multiplied by 1 plus R raised to power N. P is the principal amount, which is 100 in this case, because today we are going to invest 100. And what would be the value after 5 years? 1 is a constant. 1.1, when I say 1 is 1, plus R is the interest rate. Interest rate is 10%, so I will write 0.1. So 1 plus R would be 1.1 basically. And raised to power is N, means number of years. Let's suppose if I have to calculate for after 5 years, I'll write 5 here. So you see, simply if I write here as 100 multiplied by 1 plus 0.1 raised to power 5, it should give me the answer of 161.051. Calculate if you can get this answer on your calculator. This will also tell you whether, sorry? Okay, so let me show you. Leave it. That is 100 times 1.1 plus 1, or 1.1 is the same thing. Then it's, this should be the one. Okay, raised to power 5. Right? This is x raised to power. You simply press it and write 5. And here I just put multiplied by 1.1 raised to power 5. 161.051. Asal, you got it? You don't have calculator? Calculator is very important because this is what you have to do. 1 plus point. No. Written simply 1. 1.1. You don't need to write 1 plus 0.1. But raised to power. It's easier to do the calculation this way, but when we do the calculations in this. You have to learn this way because we're doing it. I hope you got it as well. Telling yourself in Excel, if you're doing it, does it automatically for you. But when you do it this, you're going to do an exam same way. So it's better this way. Better to learn that because in exam you're going to use that one. Okay. Even I don't know how to calculate this in Excel because in Excel there is no raised to power formula. I don't know what that is. There would be any, but I don't know what that. Oh, it is the same. Yeah. Right. It was the formula. My formula was correct. Anyway, this is raised to power, right? So. So I invented new formula today. Anyway, I did not invented, discovered. I didn't know that. Anyway, Amelia, do you know how to calculate it from the calculator?
Yes, sir. I got the answer.
Okay, good. Very good. Now, this is what we call the compounding, present value to future value. Okay. Now, I want to calculate that. Let's suppose if I invest today 250,000, okay, how much it would be after 7 years. at the rate of 15% interest rate. If the interest rate is 15% and you put 250,000 in bank today, how much it would be after 7 years using the compounding or the compound interest rate? Interest rate you have to use is 15%, not the 10%. 7, I'm asking after 7 years. How much you would have after 7? Not 100, 250,000. 4271 484 4 4.2 million something. No, you have to write 1.15 because that is 1 plus point R. This is 1 plus R. 1 is there plus R. R is 0.15. So it should be 1 plus 0.15. Ambelia got 665,000. Yeah. Same thing Amelia got, yes. Okay. Yeah, see, this is 250,000 into 1.15 raised to power 7. So you will get 665,005. Right? This is the answer. So what does it mean that if you deposit 250,000 in the bank today and bank gives you 15% interest, after 7 years, your amount would be after 7 years, you will get this amount in your bank. Understood? Now, the reverse of this side. Before I go to the third type of interest, we have studied simple interest. That's the compound interest. Third is the effective interest. Before I go to the effective interest, let's understand the reverse of this, which is called the discounting. This was compounding. Now, discounting is what? This is called future value to present value. You have to calculate the present value from the future value. Now, let's suppose if discount rate is 12%. Inflation rate or discount rate is 12%. Okay. A person says, okay, invest 250,000 today, and I'll give you these amounts. In first year, I'll give you 70,000. Second year, I'll give you 60,000. Third year, 50, 50. And how much in total has become? Okay. Okay. Last year, 70. It's a 5-year project. So if I see in total, the person is giving me a 300,000. Today, I am going to invest 250,000. So investment, I will write in negative term because for me as an investor, this is a cash outflow. And all others are cash inflows. The person or the business says that invest today 250,000 and I'll give you 70, 60, 50, 50 and 70. So it means the person says me if on the face of it, it seems that I will be getting how much? 300,000. Okay, make it a little bit further. It is 80. So in total, it will be 330,000. Okay. The question is, should I invest this in this business or not? For that, what I have to do, I am investing this money today in year 0. This amount I'm getting after 1 year, 70,000. So I have to calculate the value of this 70,000 in today's term. That what is the value of 70,000 today? If I discount it at 12%. Okay. Now the formula for discount is the reverse to this. Compounding formula is this. The discounting formula is P multiplied by 1 divided by 1 plus r raised to power n. Okay, so it will be inverse. So what I'll do, instead of p taking, I'll take the p later. First, I will calculate the discount factor using this formula. If I use this formula, I will calculate the discount factor for every year using the 12% interest rate. Okay, discount factor using this formula. This is the opposite formula to this one. This is 1 plus r raised to power n, and this is 1 over 1 plus r raised to power n. You have inversed the thing. Now, if I calculate discount factor here, so 1 divided by 1.12, 1.12 raised to power 1, because this is, sorry, not year 0. Let me calculate for the year 1. Yeah. 1 divided by 1.2 raised to power 1. This will be the factor. I will multiply this factor to my principal amount, which is 70,000 in this case, because after 1 year, I am going to get 70,000. This will give me the value of this 70,000 in today's term. What is the answer for this? This will give you 0.893. I will convert it into 3 digits. 0.893 is the discount factor for year 1 at 12%. Again, don't make it too much complicated, honestly. It is just a reversal of this formula. In this formula, what we have done, we have taken the principal amount, which is 250,000, and multiply by 1 plus r raised to power n, or 1 plus interest rate raised to power 7. In the discounting, as discounting is opposite to compounding, because in discounting, we calculate the future value from the present value. And in compounding, we calculate the present value from the future value. Means a person has told me that I will give you 70,000 after 1 year. So this 70,000 is a future value. I have to calculate what should be the present value. So simply what I would do, I would inverse the formula. 1 divided by 1 plus r raised to power n. This will give me a discount factor. I will then multiply this discount factor to the amount, and that amount will be the amount in today's term. Let's suppose if I multiply 70,000 to this 0.893, this gives me the value in today's term. It means if I get 70,000 after 1 year and the interest rate is 12% or inflation rate is at 12%, so it means I will get in today's term 62,500. So what I will do, I will convert all the figures in today's term. I want you to convert all the remaining figures into today's terms. The difference is only that when it's 2 years, it should be raised to power 2 instead of 1. Okay. Another thing, let me tell you, even if you don't write this raised to power 1, still it will give you the same answer. 0.893. It doesn't matter, because for the raised to power 1, if you don't write, still it is raised to power 1. It is automatically. Okay. But if you write raised to power 1 or not, it doesn't matter. But for raised to power 2 or 3, you have to write it. So the formula here would be same, but raised to power 2. So these are the formulas which will give you the discount factors. So use calculator. No, use calculator. Write 1 plus 0.12. What is the answer? So I have added it simply. Instead of writing, no worries. You can ask, anyone can ask, don't worry. We have, don't let the other, you can ask me, no problem. Okay. Yeah. Uh, don't get, yeah, Amelia has already calculated as the year two factor as 0.797.
Yes, it's 0.797. It's 4783.
Discount factor, you should first calculate the discount factors. Okay, then calculate, because in exam you may be required to calculate discount factor even. Okay, so for this point 797 0.712, when you will round it off in 3, it will become 792. Match your answers and see if you are unable to understand anything. Hassan, understanding it? Yeah. It's easy, but as you don't have calculator, yeah. Yes, Vida, calculated all the figures. So it means that after 2 years, if I'm getting 60,000, the today's value for that 60,000 is 47,832. It means if someone gives me 47,832 and I have to calculate what would be the value after 2 years at 12% interest using this formula, I can calculate. Let me tell you this. See, the value is 47,832 multiply. See, try to understand. I'm going to reverse it. This value, today's value, multiplied by 1.12 is the interest rate raised to power 2, because this value is after 2 years. I have to calculate. So this should be 60,000 reverse. See, so I have reversed it as well. What does it mean? That if I'm getting 47,832 today and interest rate is 12%, after 2 years, it will become 60,000. Nothing right now, it's good or bad. It is just that how much will be the amount after 2 years or something. What I'm calculating is that if the person says that I will give you this, I will convert all these figures in today's term. See another, if I get 70,000 after 5 years and inflation rate is 12%, actually today I'm getting 39,720. In today's term, I'm getting 39,720. You see, I can calculate it 39,720 multiplied by 1.12 raised to power 5. So it means after 5 years, it will become 70,000. Okay, so it means if someone says me, okay, I'll give you 70,000 after 5 years and inflation rate is 12%, I will consider 39,720 in today because I'm investing 250,000 today. So it means today I am investing 250,000. If I add all the cash inflows, it becomes 238,770. If I add all these figures, sum this to this. See, it becomes 238,770. It means that if I invest 250,000 today, I'm getting 238,000 today back. It's a loss. Okay. On the face of it, it was not loss. On the face of it, I was getting 330,000. But when I converted, another thing, let me tell you, if the discount rate further increases, my loss will continue to increase. If the discount rate is, let's say, 15%, my loss will be more. If the discount is decreed, let's say it is 8%, maybe I'll get profit. Yeah, let's do it by 8%. Okay, right now, this is my loss. The loss I will call. Now, this is what, let me tell you technical terms for this as well. This is the present value. What I will call, these are the present values. 250,000 is in year zero. Year zero mean today. This is already a present value. Vida, please try to understand this, what I'm telling you. 250,000 is already present value because it is in year zero. Year zero mean right now. This 70,000 is not present value. It's a future value because this was after 1 year. But present value of the 70,000 is 62,500. Right? 60,000 is not present value. It's after 2 years. Present value is 47,832. So these all are present values. Now this is outflow and this is inflow. So I will call it the present value of outflow, 250, and present value of all inflows is 238. It will give me the net present value. Net present value. In short, this is called NPV. NPV stands for net present value. So my net present value is negative 11,230. Whenever NPV is negative, do not invest because it's a loss. Whenever NPV is negative, never invest. NPV means net present value. How it is calculated? Present value of outflow minus present value of inflows. Okay. Now let's calculate the NPV at 8%. Keep all this in front of you. Let me write the years here again. 1, 2, 3, 4, 5. Now I want you to calculate the net present value at 8%. Amounts are same. These are the amounts. These are the amounts to be used. And I want you to calculate the net present value. Because at 12%, net present value is negative. But let's see how much is the net present value at 8%. First, you will have to calculate the discount factors using 8% discount. Then calculate the present values by multiplying with the discount factors. Eight percent is 0.08. 0.8 is 80%. When we say 0.8, it means 80%. If you have to write 8%, which is less than 10, so 10 is what? 0.1. So 9 is less than 10. So it would be 0.09. If you write 0.9, it's 90%. So in the formula, you should write 1.08, not 1.8. If you write 1.8, it means 80%. Sorry. You can write 8% on calculator, no worries. But it's better to learn these percentage in formula. It will save you a lot of time in exam. And in exam, time is the money. In general, time is money as well, but yeah, no problem. In general, we have enough of this money, but in exam, we are short of this money. Same, this is a project. The person asks you to invest 250,000 today, and he says that I will give you these amounts. Let's suppose interest rate is 8%. So the question is whether this is worth it or not. At 12%, I have calculated that it doesn't worth it. Now at 8%, you have to calculate the same thing. It's not under year two. It's basically, let me write it over here so that you don't consider it as a value under year two. For the year zero, remember the discount factor is 1. For the year zero, discount factor is 1. If I give you, Vida, I give you 100 now, how much it is worth with you right now? If I give you 100, how much it would be? 100. So it means 100 multiplied by what is equal to 100? 1. If you multiply, so it means the discount factor for year zero figure is 1. It's the same thing. So I will write 250,000 multiplied by 1 is equal to 250,000.
Getting different also, we're getting different. See, this is.
All you need is the same thing,
Divide.
same formula for this is the formula for discounting. See, instead of 12, write 08. $1.08.
Guys, I mean, you guys are wrong. Easy.
Yeah.
I was.
We all are wrong.
We all are wrong. One, two, so one.
Yeah, but we didn't do.
This guy, guys. But if I do 1.08, it's this answer. See this. Vidya?
Second. 64814.
Yeah.
Okay.
Exactly.
Okay.
I thought, okay. What do you do?
Just 8.
Uh,
Match your answers. Make sure you calculate for every year. Do not just copy the information. Just say, okay, I'll do later. Try it. Do it by yourself for every year.
I did it, sir.
Very good, Milia. Figures are the same.
Yes, sir.
Good. Everyone, please do it. If you are unable to get any figure, do let me know.
I'm getting the right answer. It's okay. You can continue.
No worries. You can take your time. No problem. Yeah, you can take your time, understand it. If you're done, then we'll continue because we are not moving forward. We still have to understand the whole phenomena. Not profit, it's a positive NPV. Yeah. The same project. Project has not changed. First you said don't invest, and now you said yes, invest. So it's all about your mind. That we will discuss. Let everyone understand. Got it? Now let's understand this situation. It's important to understand this because calculation is one aspect and understanding is other aspect. This is the same project. We are talking about only one project. Previously, we said do not invest. Why? Because NPV is negative. Now we are saying, okay, invest because NPV is positive. Why is that so? Just because we have changed the interest rate. Okay. Now it means there are different people having different required rate of returns. If let's suppose I have enough money, a person says, okay, please invest into my business. I say it's okay, invest it. How much return? Okay, whatever the bank is giving, give me that. Bank is giving 8%. Okay, give me 8%, no problem. So for me, if I ask if my required return is 8%, this project is good. But if there is another shareholder who says, no, I will not take less than 12%. For that shareholder, this project is not good. It's all about your perception, your risk level. Okay. If a person has the bike, you ask him, okay, how is the Toyota Yaris? You say it's a very good car because it's better than bike. But if person has a Mercedes, you ask how is Yaris, he will say it's not good. So Toyota Yaris is the same car, but for someone it's very good quality, someone it's very bad. In the same way, a business investment is the same. For someone, it's an acceptable investment. For someone, this is not acceptable. So it depends that what is the required rate of return. The lower the required rate of return, the higher is the NPV, net present value of that project. If you decrease further this required, for example, 8% to 5%, this will increase further. NPV means net present value, the present value of outflow, which you are investing today, and the present value of all inflows combinedly. So these are the inflows 70, 60, 80, 50, but these are inflows in the future. So first convert these inflows to the present terms by applying the present value formula. Once you have calculated the present values, now calculate the total present value, which is this one in this case, which gives you a negative NPV. And in case of 8%, this gives you positive NPV. It means that if I ask 8%, the project has more than this. Project is giving me a positive NPV means if I ask 8%, the project return is more than 8%. But if I ask 12%, the project return is less than 12% because my NPV at 12% is negative. So the question is, what is the project return itself? It may be somewhere in between 8 and 12, maybe more inclined towards 12 and less means it should be more than 10% maybe. Because if I ask the 12% return, it's a negative NPV. It means project is not capable of 12%. Project may have less than 12%. How much is that? I don't know. But if I ask 8%, NPV is positive, it means project is giving more than 8%. So project return is in between 8 and 12. We call it the IRR. IRR is actually the return of the project. We call it internal rate of return, IRR. So how to calculate IRR? There is a formula which you use to calculate IRR. Honestly, I forgot that. Let's see. That is A divided by A minus B multiplied by A minus B. I think this is the formula. We'll see whether this is correct or not. In this, A is equal to, capital A is equal to this one, this one plus, it was plus, maybe. We'll see whether we can, evaluate it. If our answer is in between 8 and 12, so then the formula is right. Otherwise not. This is what you see. Okay, what is capital A? This is capital A is the positive NPV. Means this is 14,154. Okay. What is capital B? Capital B is negative NPV. What is small a in this formula? Small a is interest rate at positive NPV, or you can call it interest rate at positive NPV mean higher NPV. Higher NPV means lower interest rate. So why not write it as lower interest rate? And B is higher interest rate. Okay, let's put the values here. A means the positive NPV, which is 14154, right? Divided by A plus, sorry, minus B. B is negative NPV. Multiplied by higher, lower interest rate. Lower interest rate is, which is actually B minus A. B plus A plus B. Okay, I think it is B minus A. Huh?
A minus. Wait, 1 second.
Okay,
Edison.
no problem. It was, let me tell you. B minus A, that's what I'm saying.
Oh, my
I
bad.
told you, I think it is B minus A. Okay, so B means higher interest rate, which is 12 or 0.12 into, sorry, minus 0.08. The formula says it is into B minus A. Yeah, I think this formula here is wrong. Means-
We just add the small a at the beginning of the formula. So the A plus.
Yeah, A plus, one thing missing, yes. Here it is small a plus everything. So if I add small a means this is 8%, right? So 8 plus all this. Now I don't know how this formula will work or not.
A minus B. A minus B will be plus.
Yes, it is right now. No, it's right. Okay, these are the figures and this is the formula. Oh, it is changed. Was okay, the values have changed, right? So if I don't put here, right? Okay, we have done this. Now let me explain you the formula. Again, before going through the formula, let's understand what it is, internal rate of return. This is the return of the project itself. I told you that it would be 10 point something if you remember. More inclined towards 12, less towards 8. Why? Because I know that it is if I have to do it 0, it is this thing is more towards 0. This thing is far from the 0 as compared to this. So it means more towards 12 and far towards 8. Because the IRR is the rate of return of the project, which is 10.23%. So it means if a person say my required return is 10.23%, for that person, for this project, NPV would be 0. Because whatever the person is demanding, the same project is giving. So neither profit nor loss. Okay, that's called a 0 NPV. Now, how do we calculate this IRR? We have to take this formula A plus here again one bracket and here another bracket will add. Small a is what? This is the lower interest rate. So in these two, one was 12%, other was 8%. So lower is 8%. So we'll take 8%. We'll write the percentage here or simply write 0.08 as well. It will give you the same thing. Okay, I have written the percent, so it has given me in percentage times. Okay, 8% plus A. A is what? Capital A is what? That is positive NPV. So this is positive NPV. Capital B is what? Negative NPV. So A minus B. You see, negative NPV is already in minus. So minus minus would be plus. So when I have done this, so I have taken the reference of cell in this. Okay. See, I have taken the minus C18. When I say C18, so C18 is already negative. And I have put a negative sign. So effectively, they are adding with each other. Okay. So if you are using the calculator, make sure you add this A divided by A plus B means add both of the things and divide it by that figure. Okay. And then multiplied by B minus A. B is the higher interest rate, which is 12% means 0.12 minus lower interest rate 8% means minus 0.08. Write the percentage word or write the point words in same thing. So 10.23 is the IRR, which is the correct answer. So I want you to calculate this 10.323 using calculator. See if you can calculate the same figure or not. Because in the next question, I'm going to give you full-fledged question and I have to calculate. I will ask you to calculate IRR at that. You have to perform the whole procedure and not one, not two will practice so many questions. Then we'll move forward. Use the calculator to calculate this figure. Because everything is in front of you. All you need to do is to put the figures. It's better to calculate separately instead of calculating everything at once in calculator. Separately means that given it's small, but it will be tough. See what it is. A plus two into B minus A.
Okay, I'm going to figure.
Yeah, first it is 8% plus 154 divided by, now instead of writing this, you add both of these figures. 14,154 plus 11,237. Yeah, it's okay. 0.1023 is 10.23%. Yeah. So 25,384, right? Into 12 minus 8. or 0.12 minus 0.08. 0.04.
Yeah.
So into minus 0.04. So calculate this, multiplied by 0.04 and add 8%. You get the answer. So do it one by one in steps. Very clearly, calculator for change.
It's easy this way.
But in exam, you have to do it on calculator. That's very good.
You didn't done 8% or 0.
I just wrote 8%.
8%.
Sometimes it will plus. Percent minus 40%, you charge you calculate comes divided by this, which points for some multiplier comes.
What?
Zero points.
Yeah.
I got a longer, I think I did it all together.
Yeah, I think I got 0.1,
Yeah.
not in percentage and yeah.
Yeah.
Even if you do it together, it's easy.
Well, first do it in the same, just you can
Just first
get the answer for this.
and then,
Whatever.
and then see.
What's the answer for this?
Easy method. Thanks, then.
Okay. Yeah, this is into
Easy, do it together.
0.04.
First do it this way and then do it together. Have to take care of the values. So, I.
Something.
It comes around.
You communicated first 8%. That is not there. It should be 0.3.
Thing it is, because there's some penalty or something.
Or simply write, just leave it, don't do it. Just calculate the input. 10, 14, 154. Divided by. In bracket.
Do it together.
1, 4, 154 plus 1, 1, 2.
Go to the question, then you get your and get loss.
You got it all.
I said it already.
What?
You're telling do all together.
No, do all together, yeah. There's more you can. But just take your.
Okay, let's just keep quiet. Let me do it. I know what that I'm doing.
Ah, you're doing this way. But you said you're doing to end.
Plus.
Let's see,
plus
your
point.
others into 11, let's see.
Tonight.
Not 8, actually 8%. Percentage points. Yeah, 10.2. That's the. Yeah, if you want to show it in the percentage, you have to multiply it. That would be the question. If you know it's 0.1203, we can. Okay, let me give you another question, which you have to do at your own. There is a project which require you to invest 500,000. Why not? Okay, so first you have to calculate using 10% NPV, and then you have to calculate the NPV using 15%. And then calculate the IRR. Means these are the two percentages where you have to calculate NPV at 10%, NPV at 15%, and then finally IRR. Okay, this is your assignment. So Amelia, take your time. I'm going to call this class off now. Pause, just do it and send me through WhatsApp. These guys are sitting here in the class. They are doing in the class. We don't have to study anything else. So we'll have a break of maybe 10-15 minutes and then we'll start FA at 3 p.m.
Okay.
Okay.
Thank you, sir.
Okay, welcome.